What about using debit spread to speculate in stock markets? Opposite of a credit spread, this strategy involves buying an option and selling another option of the same type but further out of the money. It requires an upfront cost debit but can result in larger profits. What is the primary objective of the debit spread strategy in stock options trading? The primary objective of the debit spread strategy in stock options trading is achieving capital appreciation with controlled risk. This strategy involves simultaneously buying and selling options of the same type, either calls or puts with different strike prices, resulting in a net debit, which is the cost to the trader's account. The goal is to benefit from directional moves in the underlying asset while limiting the maximum risk. The primary goal of a debit spread strategy is to achieve capital appreciation while controlling risk. This strategy involves buying an option and simultaneously selling another option of the same type, such as a call or put, but with a further out-of-the-money strike price. The trader pays an upfront cost, typically a debit, for the spread, but stands to gain larger profits if the market moves favorably. How does the debit spread strategy perform under different market conditions? The debit spread strategy is effective in directional markets, meaning it performs well when the underlying asset moves in the predicted direction, which is either upward for call spreads or downward for put spreads. Its effectiveness is reduced in flat or highly volatile markets where the direction is unclear. Debit spreads are most effective in markets with a clear directional trend, either bullish or bearish, depending on whether a call or put spread is used. A call debit spread is suitable in bullish markets, while a put debit spread is preferable in bearish markets. These spreads can benefit from market movements in the expected direction while limiting losses in unfavorable scenarios. What risk is associated with the debit spread strategy? The risk associated with the debit spread strategy is limited to the initial net debit paid to establish the spread. This limited maximum loss provides a controlled risk environment. The strategy does not expose the trader to unlimited losses, unlike some other options strategies. The risk in a debit spread is limited to the initial cost of setting up the spread, which is the net premium paid. This amount represents the maximum loss if the market moves against the position. The controlled risk nature of the strategy makes it attractive for traders who want to limit their downside while having the potential for higher returns compared to outright option purchases. What potential rewards can be expected from a debit spread? The potential rewards from a debit spread can be higher gains compared to the initial investment.